My guests are Michael Purves, Chief Market Strategist and Head of Derivatives Research at BGC Financial. Also with us, Steve Blitz, economist at ITG Investment Research. Prior to being at ITG, Steve created derivatives market strategies at Solomon Brothers. Good to have you with us. Thanks so much for joining us. So, when you hear about a report like Amazon.com on the one hand, and yet you see the stock buybacks coming from IBM. You just had the announcement from Costco today that they're going to be initiating a bigger stock buyback and they're increasing their dividend. Does that give you any kind of confidence that this market is going to go higher, that we can find good news amongst all of the mediocre reports?
Well, I think the first thing is, I think that the first mistake is to paint a few firms and say the whole market.
Good. All right.
Okay. I think that's the first thing. I think there are certain stocks that can continue to do well. This recovery is being engineered to really be centered in the real good sector of the economy. So whatever firms that are involved in that sector of the economy should continue to do well. Those that are not, financial sector, real estate, less so.
Now, you've written, Steve, that one of the things that quantitative easing has done is it has, in a way, tried to rebalance the economy a little bit, and it's shifted the debt burden of the economy from one group to another. Explain the details and the implication, because it hasn't removed the debt burden, it's just shifted it.
Well, there's two parts of that. One is the fiscal side. By the fiscal side coming and doing what they've done, they've in effect replaced the implosion of private credit with public credit to help keep the economy going. In the bringing about of QE2, what the Fed is really doing by buying the debt of the federal government, actually the deficit of the federal government, and in effect swapping it for reserves into the banking system. If you look at what our trade balance is always, by definition, the imbalance between domestic saving and investment. By the Fed coming in and doing that, they're in effect closing that gap. And they're doing it, the transmission effect becomes the weaker dollar. And the hope, obviously, is that you help generate more export growth. Ever since this recession really began, even going back to when Paulson and Bush were in charge, the notion was always to generate a recovery that gave us a more balanced economy. And a more balanced economy means bringing down consumption from 70 to 65% of the economy and really building the export sector of the economy. And a weaker dollar policy, and the dollar's only back to where it was in 2007 before the flight to quality gave the dollar a bid. And so the whole point here is really to help the real good sector of the economy grow and spur capital investment to help the real good sector continue to expand.
Michael Purves, do you concur?
I think Steve makes some great points there. I'd just make one other point, which is that as quantitative easing 1 and quantitative easing 2 in particular have happened, one thing that is interesting is that there's a little bit of a polarization thus far in that equities have been, we've seen a great rally since Jackson Hole last August and onwards and upwards. So equities have clearly been benefited. Housing prices, which he clearly wants to inflate but has yet to be successful with, are really stuck at 2003 levels, and we saw some bad numbers there, yet again this morning. And so what's interesting, household...
Right, the Case-Shiller numbers coming out down 3.3% or nationwide.
Exactly, and mortgage rates are kind of bottomed out in October, November. And so the housing market, which is arguably more important to the overall national consumer, if you will, still needs that boost, and we haven't gotten that yet. So the upper tier of society that owns equities is seeing a benefit here, but there's still some polarization going on.
Michael, you've written about something called the wolf market. What do you mean by the wolf market?
Well, the wolf market was a condition that we saw in spades last summer and last spring, which was a range-bound, technical, volatile market, a market that drove a lot of analysts and managers crazy because it didn't get into a clear bear trend or a clear bull trend. Now, I would say, Bernanke's genetically engineered bull has stomped down the wolf right now, and we're just getting through yet another sort of technical level right now. But I would also suggest that if we'll see what he says tomorrow, and we'll see what happens over the next few weeks. But if, in fact, if the quantitative easing were to abruptly stop, I think we could expect a pretty serious correction in asset prices, and I think we'll be back into a very clear wolf market condition, but not a full bear market.
Steve Blitz, unfortunately, I'm only going to give you 15 seconds, but you're sticking with 3% GDP for the United States, right?
Right, which was below the consensus when the year began, and the pullback in the first quarter is no big surprise. I happen to agree with the idea about the equity market being in danger of a pullback when QE2 does end, which I believe it will after the FOMC meeting.
We got to leave it there. Steve Blitz, ITG, Michael Purves, BGC. Thank you, gentlemen, very much.